Silver just had its worst week since the 1980s, down 14% in 5 trading days, down below $70, down for the entire year. And at the exact same moment, the Federal Reserve just made a decision that virtually guarantees the long-term bull case for precious metals has never been stronger. That is not a contradiction. That is the setup. I have been covering this market every single day, and what I am about to walk you through is a framework that connects 4 data points the mainstream financial media is deliberately keeping separate. If you are holding silver or gold right now and you are feeling uncertain, the next 15 minutes are going to change how you see this entire situation. Subscribe right now because this analysis is not available on any mainstream financial channel, and I am going to show you exactly why this crash is not what it appears to be. Let me set the table. On Wednesday, March 18th, the Federal Reserve voted 11-1 to hold the federal funds rate steady at 3.5 to 3.75%. That was expected. What was not expected was the dot plot. The committee now projects only one rate cut for the remainder of 2026. One. And here is where it gets interesting. At the same time they announced this, they raised their inflation forecast to 2.7% for the year on both headline and core PCE. Think about what that means. They are telling you inflation is going higher, and they are also telling you they are not going to cut rates to stimulate the economy. They are trapped. Jerome Powell said it himself during the press conference. He acknowledged the tension between their two mandates: upward risks for inflation, downward risks for employment. His exact framing was that this puts the Fed in a difficult situation. Let me translate that for you. The Federal Reserve just admitted on live television that they do not have the tools to fix what is coming. Now, here is the part that matters for silver. On the exact same day the Fed made this announcement, the United States national debt crossed $39 trillion for the first time in history. That is not a projection. That is not a forecast. That happened on March 18th, 2026. The same Wednesday, the Fed held rates steady. According to the Joint Economic Committee, the national debt has increased by $2.64 trillion in just the past 12 months alone. That works out to $7.23 billion per day, $301 million per hour. Let me say that again, $301 million every single hour. And the Congressional Budget Office projects that net interest payments on this debt will consume nearly 14% of all federal spending this year. The government is now spending more on interest than it spends on defense. And with rates frozen at 3.5%, those interest payments are not going down. Now combine that with a war. The United States and Israel began strikes on Iran on February 28th. Oil is above $112 a barrel. The Strait of Hormuz is disrupted. Energy costs are ripping higher across Europe, Asia, and now North America. War spending historically adds trillions to the national debt. Peter Schiff made the point this week that the ante for the Iran conflict has already risen to $200 billion and could easily reach into the trillions. Every dollar of that spending gets added to the $39 trillion. Every dollar of that spending increases the pressure on the Fed to eventually reverse course and cut rates aggressively. And when that happens, when the money printer turns back on, that is when precious metals go parabolic. We have seen this playbook before. It is not speculation. It is a pattern that has repeated in every major conflict cycle for the past 50 years. But right now, you are watching the paper price crash and wondering if the thesis is broken. It is not. And here is the data that proves it. COMEX registered silver inventory has fallen 31% since October 2025. As of late February, registered silver dropped below 90 million ounces, a level that market analysts consider the stress threshold for physical delivery. The current coverage ratio sits at just 14.1%, meaning there are roughly 7 paper claims for every single deliverable ounce of physical silver in COMEX vaults. In January alone, 33.45 million ounces were physically withdrawn for delivery in just 7 days. That is 26% of the entire registered inventory disappearing in a single week. February set the highest delivery volume in modern COMEX history for that month. with over 25 million ounces delivered. And March, the primary delivery month, opened with more than 10,500 contracts standing for delivery, representing over 52 million ounces against roughly 86 million ounces of registered inventory. Think about this for a moment. The paper price is crashing. You are being told silver is in trouble. Meanwhile, behind the scenes, physical metal is being pulled out of COMEX vaults at a pace that has never been seen before. The price is falling, but the product is disappearing. That is not a market, that is a magic trick. Now, let me give you the framework for what is actually happening. There are two completely separate markets operating simultaneously, and the financial media treats them as one. Market number one is the paper futures market, where leveraged speculators, hedge funds, and algorithmic traders set the price. According to CNBC, managed money positioning in silver futures has collapsed 77% year over year. The tourists and momentum chasers who rode the 135% rally in 2025 are leaving. An analyst at SP Angel made this point explicitly this week. He said central banks drove the first leg higher in the multi-year bull run, and then the tourists came in. Those tourists are now exiting. That is what is pushing the paper price down. Market number two is the physical market, where industrial users, central banks, and long-term holders are buying actual metal. Shanghai Gold Exchange inventory has dropped 43% since November 2025. Physical premiums on coins and bars are compressing after Thursday's sell-off, a pattern that historically precedes a surge in dealer-level demand. As bargain hunters step in, silver has been in a structural supply deficit for 6 consecutive years. Annual mine production sits around 830 million ounces, while annual demand exceeds 1 billion ounces. Solar panel manufacturing alone consumed record amounts last year, and that demand is accelerating, not slowing. Here is what the data tells us. When you put this framework together, the paper market is correcting because leveraged momentum traders are unwinding positions in response to a stronger dollar and higher rate expectations. This is flow-driven selling. It is not thesis-driven selling. The physical market continues to tighten because the structural forces that drove silver to $121 per ounce in January have not changed. The supply deficit has not been resolved. Industrial demand has not declined. COMEX inventories have not been replenished. If anything, the Iran war and its impact on global supply chains makes the physical shortage more acute, not less. If you are finding value in this analysis, hit the like button right now. It takes 1 second, and it helps this information reach more people who need to see it. Let me give you the historical parallel that I think is most relevant right now. In 2008, silver crashed from over $20 to under $9 during the financial crisis. That was a 55% decline. Leveraged traders liquidated everything. The paper price collapsed, and within 3 years, silver ran from under $9 to over $48, a 400% gain. The crash was the setup, not the conclusion. The same dynamic played out during the initial COVID sell-off in March 2020, when silver briefly touched $12 before beginning its run toward $30 and eventually beyond. The pattern is always the same. Crisis creates forced liquidation in paper markets. Physical supply gets even tighter because dealers cannot source metal at artificially depressed prices. The disconnect between paper and physical widens. And then when the Fed inevitably responds with rate cuts and stimulus, the snapback is violent. Goldman Sachs Asset Management said this week they still see room for 2 normalization cuts in 2026. JP Morgan's year-end gold target remains $6,300. Deutsche Bank is standing by $6,000. If gold reaches those levels with the current ratio around 65, silver would need to be trading well above $100 just to maintain the ratio, and the ratio has been known to compress dramatically during precious metals bull runs. In the late 1970s, it compressed to 15 to 1, even a move to 40 to 1 with gold at $6,000, put silver at $150. I want to be clear. I am not telling you what to do with your money. This is not financial advice. Every individual must assess their own circumstances, risk tolerance, and investment objectives. What I am telling you is what the data shows. And the data shows a structural supply deficit, collapsing exchange inventories, a Federal Reserve that is trapped between inflation and recession, a national debt that just crossed $39 trillion, and a war that is pouring jet fuel on all of these dynamics simultaneously. The mathematics of this situation have not changed because the paper price went down this week. If anything, the mathematics just got more compelling. Now share this video with one person you know who is watching their portfolio decline and feeling uncertain. Send them this framework. Let them make their own decision based on data rather than fear. There are 3 types of people watching this video right now. The first type is scared. They see the red on their screen and they are thinking about selling. The second type is confused. They believe in the long-term thesis, but the short-term pain is making them doubt everything. The third type understands exactly what is happening. They understand that markets transfer wealth from the impatient to the patient. They understand that paper price declines during physical shortages do not last. And they are quietly, strategically adding to their position while everyone else panics. Which type are you? Tell me in the comments right now. Drop a 1, 2, or 3. The era of cheap silver has ended. What you are seeing right now is the last gasp of a paper market trying to convince you otherwise. Every reference I cited today is linked in the description below. Hit subscribe and turn on the notification bell because the next few weeks in this market are going to be historic, and I will be here every single day breaking down what the data actually shows. I will see you in the next one.